back to Tip Tuesday, Ryan, and part two from our follow-up from last week, where we went into more detail about how an assumable mortgage works. And today we're going to talk about how you as a buyer can take out a second mortgage and how that works with an assumable loan. So I'm going to let you take it away, sir.
Yes, gosh, second mortgages have become so popular, and really there are three reasons. Rates, for one, are still elevated right now. Property values have gone up, and a lot of homeowners are sitting on a significant amount of equity. And then three, as we discussed last week, assumable mortgages, and we'll go into more detail about that. All reasons why second mortgages are being used so much right now. So first, if you currently own a house and you want to take some equity out, but your current mortgage has a great rate in the twos or threes, and you don't want to refinance that entire mortgage because the entire mortgage rate will increase to something in the sixes or sevens. So to take out, equity of the property without touching that low first rate, you can get a second mortgage. Now, the rate is higher on these, right now, just kind of average, maybe 8 to 9 range right now, but it's only higher for that cash that you're taking out. So you do have an option to take out an equity in the lump sum, or you could do something called a home equity line of credit, where it's almost like a credit card, where you could take out a portion, pay it off, charge it up again, pay it off. A lot of people have that. It's just great to have as a rainy day fund. So it's a lot more flexibility. So I wanted to make sure we addressed that if you currently own a house, because of course, second mortgages are very popular for taking equity out right now. But second mortgages are not just for that. As we discussed last week, there are options to purchase a home with an assumable mortgage. Now, this is, of course, as we said, where the current loan for the property that you're buying is being transferred to you, hopefully at a very low rate. So the drawback to the assumptions is having to bring in a large amount of cash to make up the difference between the purchase price and that transferred loan. But a second mortgage can make up that difference. So that's the one big thing that's holding people back, but this really is kind of the key to get around that. So in the example, if you remember what we had last week, is a buyer purchasing a home for $400,000, and they're assuming a $300,000 mortgage, hopefully in the twos or threes, much lower than our current mortgage. And again, why these are so popular. So if you don't have that extra $100,000 to make up the difference, you could get that second mortgage to help. So when we do have these options, we are actually allowed to go up to 95% combined loan to value. So for this example, if you only would need 5% down with a second mortgage on a $400,000 home, or that's $20,000. So it's much better than $100,000, obviously. So it's a very popular option to use these second mortgages, and why there's so much in demand right now if you are looking to assume a loan. So just keep that in mind, that you don't have to come in with the entire difference. These second mortgages are a great option if you do want to do an assumption. So if you have any questions on it, or even just refinancing or for purchasing, call me anytime. Number is 480-635-3035.
Fantastic, Ryan. What would the interest rate be on that second mortgage?
So they are higher, because first mortgages are safer. Banks always have to look if for any reason someone defaults on the loan and they have to, go into foreclosure. What are they going to lose? And the first mortgages, there's usually very little loss, but second mortgages are the first ones that could possibly go into default. So the reason why rates are higher is because of that. So right now they are in the 8 to 9% range. But again, it's a much smaller fraction of your total mortgage. The first one is really what makes the big difference. So when you look at the blended rate together, it's usually maybe in the 4s or 5s compared to where current rates are at, maybe in the 6 or low 7s.
Got it. And can someone pay that second mortgage off first, and then and pay only like principal or interest to the assumable? How would that work?
Yeah. So you still have to pay taxes and insurance on the first mortgage, and of course your principal and interest. But yes, you can speed up the payment and try to pay off the second mortgage faster because that has the higher rate, and maybe make an extra mortgage payment each month to it. So that is a great option to get rid of that higher interest rate.
Any refi?
Or, of course, what we're expecting is rates to drop. And so what a lot of people are probably going to eventually do is refinance them both together when the main rates drop, which we're hoping continues throughout the year, maybe getting into more of the low 6s, mid 5s by the end of 2024.
Perfect. That was going to be my next question. So
I knew it was. I felt it.
Awesome. Well, Ryan, valuable information as always. Thank you so much. Again, you have our contact information. If you have any questions, please, as always, reach out. We'll see you next week, you guys.
Bye, everyone.
Bye.